stream. Hello, everybody. Happy Sunday. It is December 29th. It is a few days after the holidays, back from Christmas. If you guys celebrated, hopefully you had a wonderful Christmas Eve, and hopefully you have a wonderful New Year's or New Year's Eve plan. So I just wanted to make sure real quick that I'm live on YouTube like I always do, so we're not talking to ourselves. So I'm gonna just make sure we're live. If someone is, I see we got one viewer so far. So hopefully that one viewer, if you could just put where you're listening from in the chat, so that way we know we're live. But I'm still going to check just to make sure, and then I'll introduce Demetrius. If you guys hadn't had the opportunity to talk to him last time, I'll make sure to introduce him. All right, here we go. So we are live, so that's good. I know people probably wonder why I'm always looking, but I just want to make sure. All right. Oh, so New Jersey. Hey, what's going on? This is my dad from New Jersey. What's going on? But yeah, so I will let you introduce yourself, say a little bit about who you are, and then we'll kind of just jump into the conversation. And hopefully more people join. We'll see what other questions they might have in regards to financing and lending.
Absolutely. I feel like I already know Dad, but for the sake of anybody that might be secretly listening, I'm Demetrius Lockett, and my job is a loan officer. And what that means is I work with people like Mr. Clark, Devon Clark, that is, to help his home buyers or potential home buyers find money to be able to buy the house. I've been doing it now a little bit over 34 years. I do it because I love it. I happen to be very good at it. I believe education is really, really important. So first of all, let me thank you, Devon, for having me on your show. I think what you do for the listeners is incredible. Your commitment is absolutely there, and it makes a difference, especially in this arena, in a place that is so confusing and so many people have so many questions about. I was talking to one of your listeners just a couple of weeks ago who's in another state, I think DC or Virginia, and he was just mentioning how happy he was that he just happened to be scrolling through the social media space and was able to find you. So what you're doing is really reaching and having a great effect on people. So thank you for allowing me to be part of that.
No problem. Well, I appreciate you. Good evening. This is my cousin. Hey, what's going on, man? We were just talking about you, how you are so ready and ready to ask questions and say what's happening in regards to the next steps you're trying to take in home ownership. So Demetrius is here. Like I said, it's a space in which you guys can ask questions. I know there are a lot of financing things on YouTube, real estate things on YouTube, but it's always great to have an opportunity, if you can, to ask questions to an actual lender who has been practicing, lending for I don't want to say decades, I guess more than a few decades, but so it's an opportunity to do so. But what we'll do is I'll open it up, and if you guys have any questions, please put it below, and we will pop it up on the screen, and Demetrius will do his best to answer it and trying to get you guys fulfilled with more information and education around financing when it comes to home loans and things like that. So I guess my first question is in regards to interest rates. So everybody always asks me when they see me, because I'm a realtor. So they always ask me, what are the current interest rates? What are they currently right now? And I kind of throw them towards Mortgage Daily News. I believe that's the website or the app that you can download as well. And that kind of just gives you the national type of, per se, average interest rate. But what are you currently seeing, I guess, right now, just in the state of Georgia, or if you want to say nationally, I don't know.
Well, that's a great question. And actually, it's a question that kind of everybody asks, right? Not that we pay an interest rate or that we know what that means. It's just we know that's a question that we're supposed to ask. But what we've been seeing right now is the average is 6.875 to 7% right now. It's the highest it's been since July of last year. Last year in July it was 6.61, and now it's up about 0.25%. A lot of people are confused by that because they know that we've had federal rate decreases in September, November, and then earlier, this month. And people don't always understand that there is, the feds don't create mortgage rates. They influence it, of course, but really mortgage rates are done by the bond market and the 10-year treasury bond, to be exact. And what that means is that mortgage interest rates are dictated by a lot of other factors besides what the Fed does. Actually, you probably noticed or might not have noticed that both times, the last couple of times that they have cut them, we saw that the interest rates the next day actually went up. And that's because you look at housing, you're looking at unemployment, you're looking at things in terms of the daily living that determine the interest rates. Not only that, but interest rates literally change daily. Sometimes twice daily, depends on which indicators are coming out. If there's unemployment numbers or if there's some housing start numbers that were different than what was expected, all those kind of things can affect what you are actually going to see in terms of rates. The other thing that a lot of people don't recognize is it's just not one rate. It's not like how much are a dozen eggs and then everybody just goes to get those dozens of eggs. It depends on your credit score. It depends on how much money you're putting down. It depends on how much money you have after the transaction, things called reserves. It depends on if you've purchased before. It also depends on loan type. So that's a very loaded question. And I would encourage prospective home buyers to, be obviously aware of what interest rates are. But I would say ask more informed questions because regardless if Devon or I told you it was 3 or 13%, it doesn't really put you any closer to really making a decision, I don't think. Yeah. You really want to know, what is a $2,000 mortgage payment by me? Or I saw a house that's, about $300,000. What does that look like? The other thing that I would caution you from, I think it's good that you have an agent like Devon who wants to give you information and education and point you to other sources to look at, which is good. But I will remind you that since rates come out every day and sometimes twice a day, it's very hard for any kind of a site, unless it's their main business, to be able to keep up with that and have any kind of accuracy. And believe it or not, the newspaper wants to report information, but they're not anxious to report the changes. So they'll put it in there. And keep in mind, if we wanted to have something in tomorrow's newspaper, we had to have it to them Friday. So now the information that you finally get when you look at the newspaper, because Devon told you to, when you have yesterday's newspaper even, is not going to be accurate information. Some people say they want to know what rates are so they can compare one company to another. I say that's great. But again, you have to compare on the same day. And again, it's not just rates, but it's rates, cost. How much is it going to cost them? What kind of service do they have? Because you don't just want to get to the finish line. You want to get there in one piece. Yeah. You want to know the process and know what's going on. And can they really close a loan? Because if you're going to get an interest rate that's 3%, but they haven't closed the loan since, 6 months, it doesn't matter what the rate is if you're not going to get approved. So I do understand that people get interested about that question. It's a good question, but it doesn't fill the need of what I think home buyers actually want to ask. So ask the question that you want and get the answer that you want.
Yeah, and that's what I like you said. I agree with what you said too, because interest rates do change daily, hourly, weekly. They change frequently. So, and like I said, most people, we kind of had this discussion before another live. Most people thought, and there was a bunch of realtors running around here telling people too, when the feds had those cuts, that the interest rates were going to the mortgage rates.
It's very confusing. You would think that one would mean the other, and a lot of times there's usually a greater correlation between where the 10-year bond is and where the 30-year mortgage rate is. But since we've had so many things going on in the country, the normal 1.9% difference between the two is now somewhere like 2.4%. So it hasn't really moved. Our 10-year bond is somewhere about 4.5. And to answer your question, average rate right now is about 6.8.
because I'm like, and then I like what you said too, as far as those determining factors too, right? Because everybody real estate journey is different, is individualized. So just because one
Absolutely.
person got, let's say, a 6.2, that doesn't mean you're going to get 6.2, because you said it's all like your debt to income ratio, your credit score, other type of overlays. Because I know I was dealing with one person before where they went through a down payment assistance program down here in Georgia. It's called Georgia Dream, and they went through that, and they had like a lower rate per se for those Georgia Dream applicants. However, that particular lender that came to me through, she required that they get a certain amount of closing costs, I guess, to kind of give that rate somewhere in there. So
Absolutely.
I don't. So yeah, so it's very like you said, it's very individualized. It's very different depending on where you're at, and really going deeper with the questions. I think sometimes I realize that some people, because they're so used to saying what's the interest rate, and they might not know as much. So it's almost like trying to also, I guess, kind of coach them a little bit and go a little deeper so
Yeah.
that they have the right questions to kind of ask the lender. And like I always tell people, I'll give them a scope of what I know, but I always tell people, like, go talk to a lender. Those are the people that know it more. They know, they know more in-depth knowledge than me. They're the ones that do the financing. So,
And
so
think
they're
about
looking
it.
at it.
It's kind of human nature. Everybody wants to make sure they're getting a good value for whatever they're paying for. And unfortunately, that's one of the ways that we determine if it's good value or not. But you got to look at the whole picture.
Yeah. So I'm like, if anybody is on live, if you're watching tonight, there's an opportunity. If you have any questions around financing, home loan, lending, please put it below in the comments. If you have anything that's personally going on in your life right now and you're looking towards homeownership in the future, this is an opportunity to hopefully get some of those kinks worked out around any questions you might have. So let's kind of go into, I'm trying to see. Go
I had
ahead.
a question for you. And I
Okay.
know you have an order, and I don't want to mess up
Mhm.
your order, but
Oh, it's
you
okay.
get started and we run out of time. I want Miss Clark to kind of share what her big news is. You said she had some big news or some kind of news set. Miss Clark, do you mind sharing?
Yeah, my cousin Lane, hopefully she's in here, but hopefully she's typing, because I know sometimes she's having troubles with the typing in the comments. So if you want to share what you kind of did, Lang, in regards to going to the bank and doing some things to for your next step and your opportunity towards homeownership, Demetrius would love to hear some more about it.
Absolutely.
So hopefully she will chat. I know sometimes there's a delay in these on the lives. It's always a delay, so she might come in after this. So if you lock in on an interest rate, will that rate rise if rates go up?
That's the beautiful thing about locking in on an interest rate. You are locked in. But be mindful that a locked in interest rate typically is not attached just to you. It's attached to you, a property that you're purchasing, and a time period in which we're going to give you the money. All of those things, including you and the people that are going to be on the loan, are important in determining that information. But no, once you're locked in, you're safely locked in. And one of the great things that a lot of lenders will do, especially in a crazy rising environment, is if the rate comes down by more than a certain percentage, sometimes it's 0.5%, sometimes it's 1/4, they will often meet you halfway, which I think is pretty incredible because they don't require that the other way around. But yeah, locking in is important.
So do you feel like the way we've kind of been moving now within the last year, and what's going to, hopefully nothing too crazy happens in 2025, do you feel like that most home buyers that are searching and interested think they should lock in as soon as they can, or do you think some of them should kind of wait? Because I know a lot of what was happening last year and the year before, people were waiting like, oh, they said this is going to happen, this is going to happen. So a lot of people were waiting, and then they end up realizing when they were about to purchase, the rates went up, and then they had a higher rate than they expected to do so. So do you suggest, I know some people say, you never know. So sometimes people kind of just, not lock and kind of float around, but do you suggest that it's better to kind of lock and adjust accordingly? I don't know.
Now, typically when you're there's two things that we could talk about: purchasing or refinance. But we're going to talk about purchasing. But when you're purchasing a house, you kind of want to go ahead and get the rate locked in. Luckily, we haven't been in an environment here recently, in a very recent history, where rates are crazy one day and off a net another day. But think about it, rates literally change every day. And so we could be looking at 5% today, and that 5% means that you qualify for, let's say, a $200,000 house, which you happen to have a $200,000 contract. Devon found the perfect house for you. It was right at your limit. So we're going to float the rate and kind of see if it gets a little bit better, because you've been watching the stock market and you know everything. So because I have to listen to you. At the end of the day, you are the one that determines. But we wait. And then there's a war tomorrow, or the president says something crazy and everybody gets scared and believes that there's getting ready to be a recession, or that the stock market is going to fall, or that they're getting ready to get rid of all of the employees at a certain company. And now interest rates are 6%. And guess what? You don't qualify, because at a 6% payment, you qualify for about $175,000. So now we have to sit and wait and hope that the rate gets back to where it was, or you have to pay for it to get lower in order to qualify. And keep in mind, in this whole scheme of things, you're under contract. So while you're waiting, you're also risking the possibility of losing money that's part of the contract. Because if the rate never gets there, you don't have any money to buy it down, guess what? You can't perform on the contract. And that's not the seller's problem.
Yeah. So I have a question too. Because I experience this all the time. When I'm working with people who are trying to buy, where it's like, let's say, I know this kind of going off a little tangent, but it kind of correlates a little bit. So let's say if the house is $200,000 and a buyer is like, they have the option between possibly utilizing either going the closing cost route or taking money off the purchase of the home. Let's say like, okay, instead of getting $200,000, I want to do $190, no closing costs. What because this is what I kind of explain to people sometimes about this. And like, sometimes, unless it's a big chunk of money coming off of that purchase price of the home, if you need the closing costs, I would go that route more than the purchase price of the home, because it doesn't make too much of a difference in the mortgage payments. But I know everybody's situation is different, so I just, again, educate, advocate, and people move the way they want to move. But what do you feel in that situation? Do you feel like it's best to go one way or the other way, and it's always great to combine them, but if you had to take a avenue?
One of the things that I really love about this business is it's a very emotional business. For, purchasing a house is emotional, the place that you want and everybody's dream. But the facts of purchasing a house are black and white. So if I was in the situation that you're talking about, I would call the loan officer and I would say, here's the two choices we have. And then the loan officer will talk with the client and say, option number A is $4,784 and a payment of $600. The other one, you need to come up with about $6,755. The payment's $25 more. Which one do you want?
Yeah.
Makes it real easy. But typically, to your point, the more that the seller pays in closing costs is the less that you have to come to closing with. And, we sometimes, again, get stuck on payment. But sometimes if your payment's going to be like $10 or $15 more, that adds up, of course. But if it means sometimes that you're going to get $1,000 or $2,000 more to get you into that house, it might just be a smart decision. But I'll leave it up to the client. I show them both options, and then they have to make a very quick decision. And I think most of the time buyers are good with that, because they're already scared. They just want to make sure they don't get cheated. That they're getting the value for their money. And anybody hears that they're getting $3,000 off the price of the house, which absolutely doesn't quite mean anything unless you're getting ready to refinance. So it just depends. It depends on everybody's situation, just like you said. how much money they have in the bank versus how sensitive they are to a payment.
And that's the thing that like I said, like you said, always reach out to the lender, have a conversation around that, because I feel like once you put those numbers into perspective, people are like, okay, I can, I could, this makes more sense going this way instead of this way.
Right.
Because I've been noticing lately a lot of more buyers are like, I want to go lower in the price of the home. And I'm like, and it's just like, unless it's a big chunk, sometimes it's not really much of a difference. But again, like you said, at the end of the day, you put it into the buyer's hand. It's not, like you said, we're just here to educate, advocate, put everything in perspective, write that down, and then see what's better for them at the end of the day. Because this is your house, this is your payment, and this is what you feel comfortable wise as a mortgage. And if you feel like getting a house for $10,000 cheaper, you won in some area, then hey, I want you to feel happy at the end of the day of where how you feel you accomplished real estate goals. But yeah, I don't know what's going on. I don't see Lane hasn't put anything in the comments yet, so
she might be shy, wanting to have a personal moment. It's okay. I'm gonna find out.
Hopefully she will put something in there. But and if
not,
anybody else is if anybody else is just tuning in now and joining us, please put any comments or questions below into the chat box. And hopefully everything is still kind of streaming, because I know that sometimes this particular platform can get a little wonky. So the next question is, I guess I'll save that one for later on. So when it comes to like the finance contingency for a buyer, so I guess I'll break it down so people can understand it, and of course you'll go deeper. But what exactly is a finance contingency?
Well, I think first we've got to make sure that we know what context they're talking about. So you're talking about in terms of a contract?
Yes, in terms of a contract. And let's say if we're going with the in terms of the contract, and then I guess what the next question will be in terms of like an FHA contract or conventional, if they differ somewhere. But yeah, so the first thing in terms of a contract.
Okay, so you're saying that when someone's buying a house, you're going to prepare a purchase contract. And in that contract, there's certain safeguards, and those safeguards are called contingencies, right? And so you were asking me about a couple of them, specifically which ones?
So the first one is just the finance contingency, and then we'll go into, I guess, the difference, if there's any difference between an FHA one, a conventional one. I guess we'll just stay between those two, and then from there,
Okay, a finance contingency is usually something written in the contract that says you, the buyer, have a certain number of days to get your financing in order and approved. Usually that time it's a time that gets negotiated. And of course, the shorter the periods, the better it is for the seller, the longer, the better it is for you. So a great realtor like Mr. Clark finds an easy medium that will get you the contract and still have you protected. But what the finance contingency says is that, as an example, I've got 20 days from the time that you sign that contract and it goes binding to have your financing clear, so that if on day number 21, I don't have it clear and I call and say, we can't get you the money, then you are at risk of losing any monies that you've already put into the contract because I did not let you know before those 20 days. And I will say that Mr. Clark does a really good job of making sure we hit those benchmarks. Internally, we also have benchmarks that help to meet it, but we always try and make sure that we give more time than we actually need to hit those time periods. And one of the ways that you can position yourself and be really strong to make sure that you don't risk any money being lost is by a few things. One, I would say you need to know your purchasing power. And what does that mean? That means doing one of the hardest things that most people do, and that's talk to someone like me. And just to find out where you stand. It's no judgment. And it doesn't even mean that you have to use the person that you necessarily talk to, but you want to make sure that you're talking to someone that is educated and knows the different programs. So that means that we're going to take a look at your credit report. And I don't even if you're one of those really, really smart people that believes that you know what is needed and you've got a few things that you want to do on your credit before a mortgage guy takes a look, I would say do it anyway. Get out of your way and let the mortgage person that you don't have to pay any money for give you the value of their experience. Because it's not unusual that you will have a buyer that is making corrections to a credit report that absolutely have no effect on the process. It doesn't bring them any closer to getting a house or any closer to getting a better interest rate. So my suggestion is that, go ahead, have your credit looked at. I would suggest what they call a soft pull. Soft pull means it doesn't affect your credit score and it doesn't show up on your credit, so that you can kind of see where your score is, make sure it's correct. And if you don't want to do that, I would say at the very least, go ahead and order your credit report from one of the 3 credit reporting agencies, which you can do online. The reason I suggest that you talk to a mortgage person is because our credit report, the scoring model, and some things can be just a little bit different. Plus, it gives us an ability to analyze that credit and tell you specifically the things that you can do and how it will affect the score. That's the first thing that I would do. The second thing is I would set up a mortgage folder. And in that mortgage folder, you're going to want to put some documents. And when I say folder, in 2025, it can even be folders on your computer. It doesn't have to be physical folders.
Okay.
But I like paper too. I like to see paper. Sometimes you want to hold it in your hand and just feel like you're actually making some progress versus just having it on the computer. But whatever works for you, create a folder. In that folder, you need to have these items. You need to have your last 2 pay stubs, your last 2 years tax returns. So right now it will be 23 and 22. In about 4 months, it will be 24 and 23. Make sure the W-2s are attached in there. Put at least 1 bank statement and 1 401k statement. You'll have to update some of those things. Hey, Ms. Hill, you'll have to update some of those things, but at least you will know that you already know where they are, how to get to them. Because a big part of the stressful part of buying a house is that you feel like you're under such pressure to find things under a very short period of time. This way, you could be ahead of the curve and not have to worry about that. That's the second thing I would do. The third thing I would do is, which is really important, and nobody ever does this. I would set up a bank account and call it my mortgage bank account. And that's where you put your money as it comes in for the house. Because what we will look at in your bank statement, and a lot of people don't know this, is that we're going to look at your bank statement to see any large deposits, any mystery money, to see if you have any payments to the IRS or other debts that we don't know about, to see if you're paying money for grandma on a monthly basis. So if you have your own special mortgage account, mortgage bank statement, then guess what? We can only criticize those things that we see. So we never even have to see that account. That's one thing that I would do. And then create yourself a real timeline and a budget to know where you can kind of put money aside. Because if you're presently paying $1,200 a month for rent, and you're saying that you want to buy a house that's $2,000, which is not unusual, big jump, but not really. That means that you should have $800 somewhere at the end of the month, right?
Yeah.
Because if you're going to be in that house next month, where's that other $800 going to come from? You should be able to know that by seeing it on your budget, and more importantly, actually living as if. So acting as if you already have that house, putting that $800 away so that you know I really can do that, because it happens very quickly. And I wouldn't be afraid to ask questions. I would have a loan officer on speed dial, a realtor on speed dial. And every time I had a question or heard somebody say something that sounded weird at the grocery store about housing, because you're going to hear it everywhere, I would text my mortgage guy or text my realtor, because it really is a team effort. It's one of the biggest purchases that you'll ever make in your life. And so many people go at it just based off emotion. So The more you ask questions, the more you prepare yourself. And as we talked about before, get out of your own way. You know,
like you say, people go at it blind. How you doing, Miss Hill? Sheila, hopefully I'm saying it right. How you doing? My cousin, she said, mortgage folder, great starter. So we still wait. He's still waiting to hear about what you currently did, Lang. So let him know in regards to you getting your new card and everything. But yeah, so when it comes to outside of that, that's very, very great information, because I actually had a conversation, and I guess we'll go back to the whole contingencies. I actually had a conversation with a young lady recently. It's in like a Facebook group. So I'm a part of a Facebook group on like, I feel like I'm all over the place, but I'm a part of a Facebook group in regards to home ownership and everything, you know, the different Facebook groups. And the young lady had a question about her student loans. And and she was like, basically, she wants to buy a house next year. She has everything safe. She don't have no debt. Only debt she has is her student loans is $26,000 worth of debt. And she has a plan that she wants to pay off her student loans either prior to buying a house. And I just said, and I don't know, I could be wrong, but just from what I've had conversations about, but I said I know typically sometimes when you do pay off that I guess big credit line per se, that sometimes it could drop your credit score. So I said, what I would advise you to do is, if you are going to pay off your student loans prior to buying a house, maybe pay it. If you had $26,000 that you got paid, maybe pay $25,199. Keep $1 in there or $100 somewhere, and then after you close, then later on pay that off. So then your credit score can kind of remain similar in the same space. But I don't know. What do you feel about that? Because I don't think people realize that your student loan debt can bring your credit score down. Well, from what I've experienced personally. So.
Well, what I've begun asking people now, especially since, I mean, to be quite honest, since with this pandemic and the millennials, we're dealing with some of the most educated buyers ever, and I mean that literally. So my first question is always, why? Why are you doing it?
Okay.
And then answer to that, or speak to that, because you're just assuming she's doing it because whatever you're assuming, right? She might be doing it because she wants her score to move. She might be doing it because she wants her debt ratio to be better. She might be doing it because grandma said before you buy a house, you got to pay your student loans off. It could be anything. So we first have to figure out.
Oh, sorry.
She said what?
I know she said. Sorry to interrupt you. I know she said she was doing it because she wanted her debt income ratio to be. She didn't want that extra debt.
Why? Again, why?
She just said she just wanted to be whole in the sense of the only debt she had would be from the house. So that was her. That's her why outside of that. Yeah.
Okay. With that being the answer, then first I would look to see if it makes a difference in terms of her qualifying. And if it doesn't, if she qualifies with or without it, I would ask her to kindly turn her brain off for 30 days. Let me do what I do, and then she can do whatever she wants with that $26,000. Because, first of all, when she buys a house, she's going to find out that cash is king, and she's going to be glad that she has some. But more importantly, it might not make the big effect that she's thinking. It's much easier to, you know, if she has a $26,000 student loan, that monthly payment is somewhere about $200. It's much easier to take that $26,000 and put it somewhere and earn at least the interest rate that you're paying on those student loans, because they're typically not double-digit interest rates like some of the other stuff. But just finding out what she wants to do, it wouldn't make a huge difference. But no, I don't want anybody to do anything while we're doing the process, because the other thing, and this brings up a good point, is when we give you a pre-qualification or a pre-approval, we're given to you based on that period in time. So if we're giving you a approval based on you having a certain amount of debt, or like Devon said, or even a credit score, because we don't really know how credit scores work. So now you're taking something out of the model, or maybe it doesn't even happen smooth like that. Now we have to do updates to the credit report, and then we've got to do updates to your bank account to trace the money. And it's just, when you make a decision to buy a house, you need to align yourself with a team. That team needs to be a mortgage person and a realtor at the very least. You need to meet with them and come up with a plan. And that plan needs to be how you're going to look for houses, what's important in a house, and also the budget and how that, and the budget should lead the conversation, not the
Okay.
house, in terms of how much you spend. Because often
Yeah.
I'll ask people, have you thought about your monthly payment? They said, oh, not really. And I said, have you thought about a house that you want? And they said, yes, it's about $320,000. Well, how much is that per month? I don't know.
Yeah, that's true.
So
That's true.
So I
So
commend you folks for being on this line. And a lot of people wonder if you can purchase a house in a business name. And you can, but again, it depends on the type of loan that you're doing. If you're talking about an FHA loan, which is typically what first-time home buyers use, it is intended for primary individuals for their primary housing. It is not for any business to do. And typically, till that business has shown some kind of credibility and payment history, even if you do get a loan in the business name, we're going to look at having you as a guarantee on that loan. So we'll give the business a chance to establish some credit, but also at the end of the day, it's still going to go on your personal credit as well and affect how much you qualify for. So we're still going to look at your personal credit as well.
Yeah, because I do get some.
That didn't answer the question, Ms. Hill.
Hopefully hopefully if you need more information, more context around it, please put more more into the chat, the live chat. Because I do know some people that are getting into homeownership with, like you said, being that there are, because of the World Wide Web, she said, thanks. Because of the World Wide Web, you are coming across, like you said, more educational home buyers now, because everybody's looking up stuff, reading stuff. So I do get some people who do come sometimes, and they say, okay, I want to utilize my FHA, or I want to utilize VA, and I want to have an investment property with it. And like you state, I'll tell them, like, well, the first year you have to live in said property. Because some people think that and so they'll be like, wait, I didn't know how to live. I'm like, yeah, if you want to, you could buy multi units up to 4 units per se, and you could live in one and have renters in the other one, and that's legal.
Say that again.
I tell people, I'm like, you can, if you utilize like a FHA loan or something, like, you can get a multi-unit up to 4 units, because once you go past 4, the 5th is 5 more is considered commercial.
You mean like a quadruplex?
Yeah, like a quadruplex or a triplex or a duplex. I gotta tell people, you can utilize your FHA and you can live in one and be able to, quote unquote, have your investment that way, right? You can rent out the other units and that's still legal, but you can't
so you
just
would
buy.
Be able to buy that with only putting 3.5% down, like a regular single family, and rent out the other pieces.
Yep,
that's pretty awesome.
And so I tell people if you want to be an investor per se, and you want the first time you utilize your FHA and you want to have investment property per se, that's the best way to go to it. Go about it instead of trying to buy a single family house and think you're about to rent it out once you close on it. Because I think some people think that they're going to use their FHA loan or VA loan or whatever, and they're going to rent out a single family right away.
Can I share something else about, because I know a lot of times we talk about this being legacy and generational wealth and those kind of things, which is pretty exciting for us. But one of the things that I've started sharing with some of my buyers, because obviously I work with a lot of first-time home buyers and a number of my first-time home buyers are now second-time home buyers or had babies that are now grown up and all those kind of crazy things. But Georgia is a big college town, right? So if you are a parent, you can buy a home and put your student on the loan as long as your student is living there. Then you still only have to put down 3.5%. You can still rent the other parts. So this is an opportunity, instead of, because the biggest barrier usually is the down payment. Besides that, it's always gravy from there. But if you could do that and then have your student become that landlord for that first period, he has now hit first investment property. as a landlord. And I think it just makes the barrier a lot easier because, normally to buy an investment property, you have to put 20% down. This allows you to get around the system, to start creating generational wealth for your family, and also help your son or daughter understand the importance of being a business owner, being a landlord, understanding dollars and cents and repair and handling people. I think that's a big sleeping part that a lot of people are missing on.
I'm not.
Even
I've been seeing.
because even if it wasn't a multifamily or a duplex, think about it. Even if it was just a single family residence that I bought over
Yeah,
here in West End, and
yeah,
my parents bought it for me, so now I'm living there and I'm renting out each room and still making
yeah,
more than what the rent's worth, and still becoming a landlord and still learning how to deal with conflict
hmm
resolution. So,
yeah,
just an
yeah.
idea.
I've been seeing some people doing that. They call them they was calling them kitty condos. They remember
Yeah,
buying like
that's the program.
kitty.
That's the program center.
So back to, so if you guys have, again, if you have any questions, please put them in the chat below. We're here with Demetrius. He is a lender out of the state of Georgia, and we're just having a conversation around financing, loans, and more. So if you have any questions, anything that you want to ask a lender while we have them here, please put it in the comments below. And so swinging back around to the financing thing, we kind of talked about what a finance contingency was, and I know. So when it comes to FHA, I know when you do a FHA, as far as putting that FHA loan contingency in place, that the finance contingency kind of is grouped with the appraisal contingency. However, when you do a conventional, they're not grouped. So why is that? Do you know or no?
Well, for a financing contingency on an FHA file, it's
Mhm.
assumed that the VAT is already written inside of the contract that the part of the approval has to be that this property has to appraise out because remember HUD owns it. And
Mhm.
if it doesn't, that's why you also notice on a conventional loan versus an FHA loan, there's an appraisal contingency on conventional.
Mhm.
There's not an appraisal contingency on FHA
Mhm.
because HUD says I'm doing the financing and they're also providing the appraisers
Mhm.
and it will be done once we know the value is there. And really, that's why most of the time when we're talking, we talk about FHA versus the other ones. Not that the other ones aren't good because they are. It's just that
Mhm.
FHA goes out of their way to safeguarding the home buyer, the first time home buyer, from getting into any trick bags.
Mhm.
Sure, their loans are a little bit more expensive because of the mortgage insurance, but
Mhm.
it sure is protective, not only just getting in the property, but also, if you have problems on the back end and you're not
Mhm.
able to make payments and those kind of things, they have a real strong advocacy program for the home buyers to stand in as well. So yeah, a lot of those things are protected in FHA.
And so do you think, I know FHA doesn't allow it, but I know during the crazy stuff of the pandemic, people were over paying the difference per se in regards to the appraisal. Do you think that's smart that people
Um,
were kind of
well,
paying that appraisal gap?
FHA will allow it.
Okay, okay.
Yeah, we'll allow you to overspend any money you want. We're just not going to loan it to you. We're only going to loan you what it's worth. Do I think it's smart? For a while I thought, boy, that's stupid. But then I started thinking about it from a rational standpoint, and sometimes people want what they want. And that was during a period, and there's still some today, I guess, but that was during a period where it was supply meet demand. There weren't that many properties. There were more buyers than there were properties. So cash was king. But think about it. If I'm coming to Georgia and and I've run into a number of people, and I'm spending $300,000 on this big, beautiful house that I want down here, and I'm leaving New York or California or Washington, and I just sold my house and I just made, I don't know, four or $500,000. What do I care? I mean, the property in Georgia is way better. It's bigger. It's still here's an extra $20,000 so I can be out of it. That's cool.
Yeah.
That was done. But I never think it's a good idea to pay more
Yeah,
than what something's worth. If it appraises out, great. But if you're talking about paying more than what the appraisal, what HUD or Fannie Mae or whoever said it's worth 150, and you say on top of that, I'm giving you another 20,000 because this is coming out of their real pocket. I think that's unfortunate that that happens. I know in places like California and New York, it's a pretty common habit or
mm,
thing that they do. I hope that Georgia does not become that way. Um,
yeah,
we're quickly moving in towards it, though. But I think we'll see
yeah,
more of that happening too, Devon, because while while prices are high,
mhm.
Georgia's still relatively low compared to other markets that are similar. You know?
Yeah, yeah. No, I'm like that's what I have been noticing. I'm like, wow. Like you said, it's very. We're still lower compared to like those bigger markets, the New York, California, and everything, Colorado, Washington D.C., all those different markets, west, north. Um, but it's just crazy because a lot of them are coming down to Georgia, and they are purchasing, which in turn
Hmm.
is kind of pushing the prices up a little bit even more. So it's a good thing, of course, to get more people come because it helps with the economy per se, helps to boost the area. But then it becomes a strain with maybe someone that might be personally from Georgia that always wanted to buy a house, and they're like,
Hmm.
how do I get into space now to get like a starter home or something to kind of just feel comfortable in for those more monthly mortgage payments, like you said, because in turn, as time goes on, property taxes go up, home insurance might go up. If you're an HOA community, that might go up. So factoring in all those different components into that mortgage, it can be very, uh, I guess, a daunting thing for someone who just might just be working an everyday job. But there are
Yeah.
there are some great millennials and Gen Zers and everybody out here making a lot of money because I see it every day. I see it every day. I'm like, where's this money coming from? I would love to
Yeah.
have some because I don't know where it's coming from, but there are people
but,
that are making a lot of money. So
but I will say that we've got to do something from an affordable housing standpoint because we're effectively pricing out the first time home buyer. We've always been about, 30 to 40% first time home buyers. Now we're still about that same number, but what we're finding is now first time home buyers, that average age is about 38.
mhm.
Where it was in your 20s, right after you got married, had a baby, that it's not happening that way anymore. Part of it is obviously because of lifestyle, but a big part of it
Mhm.
is because of affordability. The average price of a house is well over $321,000. Some say it's even
Yeah,
417 as a national average.
yeah, I
And
saw that. I was
so
like, wow.
what do you do with that? And then you have, like you said, the seniors on a fixed income who can't even possibly stay in their house because their property taxes are now more than their mortgage payment.
Yeah,
So now you have just one sector of people that are in houses. That doesn't
mhm.
sound right. We've got to do something about
Yeah.
that.
And I always tell people everybody should have the opportunity to own homes in America. I don't feel like it should be a luxury. It should be a necessity. And whether it is, even if you don't want to buy, even if you just want to rent, everybody should have an opportunity to be able to have shelter accordingly to how they feel like they want to be. Of course, it's always great to become a homeowner because that is, equity you're building, wealth you're building in a different space. It might not be a liquid wealth at the time, but it's
Hmm.
definitely an asset that grows over time. So having home ownership is definitely great. And I grew up in houses and parents and grandparents that had owned homes. Like my grandpa, he bought 2 lots in Pennsylvania, and he built a house on the lot for $25,000. So of course that was way back, during a different era, but it's just being able to come from a lineage of people that own homes and to see how real estate has made people successful. So, and in
Absolutely.
my family, as she said, an option to purchase a home is awesome. Yes. So I know we're almost at time. If you guys have any questions, don't be scared. I feel like tonight everybody's like popping in, popping out. No one's asking questions. I'm like, if you have any questions, this is the purpose of doing this live. I know sometimes for some reason I get more people that kind of jump on around 7:30, but I don't want to keep you too long. I feel like they come in a little later, so that's why I'll sometimes go overtime. But if you guys have any questions, please put it inside the live chat, And if you are watching this back, if you want to put them inside the comments as well, you can below. Demetrius' information will be below. So if you want to personally reach out to him, his email will be below as well. If you just have more questions, more comments in regards to lending and financing, he said, I'm listening and learning. Okay, you can ask questions too. I know sometimes, there's so much wealth of knowledge, especially when you have a wonderful lender like Demetrius on. So it's kind of hard to be one to say questions because you want to learn. I say anything you have in your head, no question is a dumb question. Every question is a great question. So just remember that. I guess so. We kind of talked about finance contingency, appraisal. So I had another question for you too. So don't mind, I'm looking down. Because I know we had this conversation on the phone, and I think I might have said this the last time, but kind of breaking down closing costs, because I know we had this conversation, and like you said, being very specific on what you're asking for, because some people say, I just want this. How much is my closing cost? How much should I get from the seller if I want them to pay any seller's closing costs? And sometimes you might just get that chunk, but they might not get as much as they could possibly get to kind of cover whatever else is inside those costs. So can you kind of break down closing costs for us?
I can. Well, kind of. Probably not like you would love, but closing costs is the cost to close the loan. It's how the mortgage people get paid. It's how the attorneys get paid. It's how they set up money to let the universe know that you're buying the house and all those kind of things. And of course, there's certain things within there, my origination fee, processing fees, whole bunch of what they call different kind of junk fees, if you ask me. But the industry standard is that closing costs are around 3%. And because they're all percentages, that's assuming that the house is $150,000 or higher. Because obviously, as the price goes lower, some of the fees, like the attorney's fee, stays the same regardless how much house you buy. So as a percentage, that can change. Loan origination, that's how we get paid, is typically 1% of whatever the loan amount is. So in terms of shopping or comparing, you want to try and find a lender that's going to be somewhere between 3 to 3.5%. It varies. If in fact that it's higher than that, then you obviously need to know what's going on. But typically with an FHA mortgage, again, while we like talking about FHA, there's a lot of safeguards inside of that to make sure that it happens. Sometimes it can be a little bit more if you're buying down interest rates, but we're not talking about that today. We're just talking about closing costs is typically 3%. And we did talk about it last time, but if you'll allow me to just go into this really quick, Devon.
No problem.
Okay, so closing cost. The big thing that people need to remember is that there's 3 things that are required when you buy a house. Write this down because it's important for you. We're assuming FHA, so we're assuming the down payment is one thing. The second thing are closing costs. The third thing are prepaids to set up your escrow account for taxes and insurance. So again, the first thing, down payment. Second is closing cost. Third are prepaids. Let me give you some numbers that go along with those. Because the reason I'm giving you this information and asking that you write it down is because it's going to be an incredible cheat sheet for you to be able to go and figure out kind of how much money do I need for whatever house I'm looking at, because numbers do matter. So down payment is 3.5%. Put that next to down payment. Closing costs typically are 3%. Put that next to closing cost. Your escrow account to set up your prepaids for your taxes, your homeowner's insurance policy, typically range about 1.5%. Now, it used to be 1%, but homeowners insurance has gotten very expensive. So about 1.5%. So if you add those together, look at the numbers that we just did. We did 3.5 for down payment, 1.5 for prepaids. If you add those together, you come up with 5. Does everybody get 5? 3.5, 1.5, 5. You still have one thing left. That's closing costs. That's 3%. I said that last because that might or might not come from your money, but it is required. So the total to buy a house, if you have no help from anybody, such as a seller, you'll need about 8%. So if you were buying a $200,000 house, 8% would be about 16,000, which is a big number. We know that. That's why FHA allows the seller to pay a part of or all of your closing costs and your prepaid items. So they allow them to pay up to 6% of your cost. Most of them don't because it's still a little bit of a seller's market, Mr. Clark will probably tell you. But they do pay some of them sometimes. So let's look at this example. We have a $200,000 house, 3%, which is closing cost is $6,000. Guess what? Devon found a house that works perfectly for that. The seller's paying all of your closing costs of 3%. So all you have to come up with is 3.5 plus the 1.5 for prepays or 5%. And now you're getting into that house for $10,000 instead of $16,000 because you have an agent that knows how to negotiate, that cares about what he's doing, and knows what your bottom line numbers are. So a strong agent, that's really where it matters. You could probably find your own house, I'm sure of that, because you can look at one. But in terms of negotiating, that's where they really matter. And Devon, you're a great negotiator. I've seen that myself. So they're in for a treat.
I appreciate it. So I know we have but a couple minutes, but I know I had like a couple other questions. Again, if you guys are watching this back, please put any comments or questions below inside the comment. Also, Demetrius' information is below, so if you want to reach out to him, please do. You will get as wonderful knowledge from him. And if you in the Georgia state, hopefully you guys will also look at him as someone to work with because he's a wonderful mortgage lawyer. So when it comes to our lender, I guess, I know how people want to say it. No problem. So when it comes to FHA, so this is, I guess, in regards to because we kind of talked about this a little bit offline as far as the MIP and the PMI. So the mortgage insurance, the private mortgage insurance and everything that kind of goes with those loans. What exactly is private mortgage insurance? Because I get some people that come up to me that think it's similar to home insurance, and I have to tell them it's not. So what exactly is?
That's good. That's good. Okay. So when you buy a house, your payment is consists of 4 things that you have to pay back or that you have to pay each month. Principal, that's the money we just loaned you. Interest, that's the money you're paying on the money we just loaned you. Taxes, that's the property taxes for where you live. And the other I is for insurances. Most people think it's just insurance. But no, it's insurances because it's the homeowner's insurance, which protects in case somebody damages themselves on the property or if there's a fire or some kind of unforeseen accident. That's what homeowners insurance covers. But I think we mentioned before that there used to be a time where you could only buy a house if you had 20% to put down. And there's a lot of people that still believe that they don't have enough money to put down. Well, you can put down as little as 3% now. But the reason that you can do that is because mortgage insurance, which is a company, a tool, or just like homeowners insurance, but it's mortgage insurance that bridges the gap between what you put down as low as 3% and where 20% is. We collect what's called mortgage insurance, or the mortgage insurance company collects it, because from that, they pay for losses to the mortgage company. We believe, or statistics shows, that after someone has 20% equity into the home, they typically don't default or typically aren't foreclosed on. So mortgage insurance premium is just that. It's the premium that's charged. It's a monthly amount. It varies based on credit score, loan type, how much money you're putting down, if you've been a homeowner before, and the type of programs that they're so. But that's not really something to like be scared about. But that is something, a reason that you want to call your mortgage person when you're trying to get a full payment, because that payment could be it's a percentage of how much you're borrowing. So it could
Yeah.
be $100, it could be $150, whatever it is. You want to factor that into what you qualify for and what you plan for in your budget. I think before you had mentioned in one of our conversations, Devon, about what happens if you put 10% down on FHA.
Yeah. Yep. Happens if you put 10% down. Yep.
If you put 10% down, which most people on FHA, let's face it, are first time home buyers and have limited assets, but sometimes people have gifts and those kind of things because gifts are allowed on FHA. And if you put 10% down, that does a couple of things. One is it reduces the mortgage insurance premium, because remember, the mortgage insurance premium is that premium that bridges the gap between what you put down and 20%. So surely you wouldn't pay the same thing as somebody that put down 3.5%. You pay something a little bit less for a less period of time. The other thing that it looks at is the mortgage insurance premium when you're putting that much down. And Devon, I mentioned this because I don't know if I mentioned this to you before. It also allows us to make exceptions to the credit score. So typically a credit score, we don't want to see anything lower than 580, really anything lower than 6. But as you put 10% down, not only does the mortgage insurance goes down, so does the risk of you as a buyer. So you can get an approval with a lower score than 580 sometimes if you have 500. If you put 10% down.
So is that because you almost have you put like more stake into the game, basically? Is it because like you have more stake into the game? Okay.
And that brings me back to one last thing that we talked about before on your young lady that wanted to pay off her student loan. The other thing that would be important is in understanding her why is also understanding that she have a budget, a cash flow, because it might make sense that we put $20,000 more on her house and keep her student loan, because it would impact her bottom line numbers in terms of how much money has to go out of the household, which really at the end of the day, for most of us, is the most important thing, dollars and cents. So we would just have to look at the whole thing, but everything is personal and individual. Luckily, I've got folks that'll sit down and have the conversation with them, and then we just figure it out from there.
So I guess two more things before we jump off here. I know we're a little over time, but again, if you guys have anything you want to say, please put it in the live chat while we're here live. But so I know, like you said, if you put because some people will say, okay, well, I'm going to put, if they're doing conventional, I guess I'll go conventional. They're like, I'm going to put the 20% down because I don't want the PMI. So there is a way in which you could get rid of it too, outside of having it, right? Like you said earlier, if you put more basically statements.
It is on conventional. On FHA, they want it, period.
Okay.
On conventional, it can, after 20% equity is into it. But also, again, that's a conversation that you have with your mortgage person, because there are some ways to be able to buy it out that's cheaper than putting down 20%. So again, we've got to look at the cash flow and look at exactly what it is you want to do and why you want to do it.
Yeah, I know a lot of people. It's just so interesting. Like you said, it's individualized conversations, it's personal conversations as you trying to buy stuff. But these, I guess, some of these questions that I'm asking as well, even though I know, most of them, but it's just questions that I always get from people that I talk to. So I'm like, let's have these conversations.
They're good questions.
Yeah. So I'm like, so that way, hopefully they'll get an answer. And then if anybody asks these questions going forward in the future, I'll just send them this video. So it's already here. It's already here. So I guess to kind of round out everything, let's see. I got a question right here, and then I'll round out everything with the last thing I had to say. She said, Mr. Demetrius, I'm in Delaware. Do you assist with the soft hit on the credit to prepare me for a pre-approval?
Unfortunately, we do not do Delaware. It's a great place that has a whole bunch of different rules. But to answer anyone else's question, we are approved and licensed to do all the states that touch Georgia and Texas. But Ms. Clark, feel free, if you want to call and ask me questions or get information from me, I will be glad to be a resource for you. And we can also see if we can find someone in Delaware that can help you as well.
She said that I do have to work on my credit, so she's working on credit again. But it's gonna work
Yeah.
out. I start somewhere to get to where you ultimately want to be.
Yeah.
Because like I said, I had a situation around credit. I've always had great credit. I guess I'll tell my story real quick. She said thanks so much, and then
Absolutely.
so people like talk too much, but I had a situation around credit. Basically, I had a great credit score. Went to college, great credit score. I was in the 800 credit score range, per se 850 actually. Was always getting credit cards, because once you got a good credit score, they send you a lot of credit cards. I've never been frivolously spending on credit cards. It's still to this day I don't do that. However, I did co-sign, and then when I co-signed for something else, it messed up my credit score, even though I was no longer in that space where I co-signed at. But it dropped my credit score all the way from 800 all the way down to 500 something credit score. And then when I lived in California at the time, I was trying to rent another apartment. And what happened is they were like, your credit score is this, so you can't get it. And I was like, what? Because prior to that, prior from me moving from one space I rented already, I had went into that particular apartment where I didn't have to pay any down payment to get an apartment. It was like you should pay the first month of the rent because my credit was so good. Like, I don't think people realize with credit, there's some things that you don't have to pay. You're not paying as much as somebody else that has a bad credit score. And those are like the great things around credit that you kind of get, I guess, opportunities per se with better credit score. You don't have to pay as much pay twice as much for the debt in which you're borrowing, or no debt at all. So I kind of saw that up front when I was with credit. But then like seeing the opposite way. But then eventually, I think we talked about this last time, I rebuilt my credit and got it back to 800 again, like 820. But it was just, it's just very interesting. And that's why I tell people you can definitely, things happen in life. We go through stuff. So even if it falls down, you can definitely pick yourself back up. But like you said, talking to somebody in the finance area, or if you're especially in the lane of trying to purchase a house, talking to a mortgage lender to tell you how to get on track to get those, that credit score up and be in a space where you can eventually be able to purchase. So we will end with the last thing. So yeah, that's my little that's my little abridged story of my credit. But if y'all want a longer story, just let me know. But so I guess the last thing I guess I would end up with, unless you guys have any questions prior to us getting off here, because I don't want to keep Demetrius all night. But the last thing I guess I would say, what are some tools someone could use to set themselves up for success to purchase in 2025 if they're looking to purchase a house? What are some tools they could utilize?
I think a couple tools. One is if you're not signed up on credit alerts for your credit bureaus, I would go ahead and do that. That's very simple. You just call the credit bureau. You can Google, and typically you can get a free credit report. So you can go ahead and get that so that you take heed as to where your credit score is. You want to look at that report and make sure it's accurate.
Okay.
And then once it's accurate, I would sit with somebody that knows credit, or preferably your mortgage person, and say, where do we go from there? That's one thing. Making sure that you get your credit report, that you lock it down so nobody else can use it, and that you look at those things to make sure that they're accurate. I would also make sure that if you have not already done your taxes for the last couple of years, that you go ahead and get that out the way. Even if you owe money on your taxes, you can set up a payment arrangement and still buy a house. The third thing I would do is have a conversation that really has nothing necessarily to do with pulling your credit or anything else. Just a conversation with a mortgage person and a realtor, and just go through all the stuff that you believe is true. All the negative things that's why you haven't bought a house already. All the things you know to be true, what your granddad said, all that stuff. I would have that conversation with someone that you trusted in the industry that can walk you through those things without trying to sell you anything, but just let you know that the boogeyman in the closet is really not in the closet or underneath the bed. Like Devon was saying, you should have the choice to buy or rent whatever you decide to do. But I will say that those people that it is written supposedly that those people that buy property by 2025, within 5 years of that time period, will have experienced over $100,000 in equity.
Mm-hmm.
For those that might not know what equity is, it's like a bank account. It's like you have $100,000 that's sitting up in a bank account just because you're living someplace. Here's the other thing to think about is owning a home is one of those few things that I know of that I can stay in for the next 20 years, pay my mortgage, and I get all my money back. So it's almost like I've been living for free with the ability to do whatever the hell I wanted to do in my house. You know, most renters pay over $330,000 in rent before they become homeowners. Don't do that. You don't even have to want to be a homeowner. Just buy a house and then sell it. Everybody wants money. I don't mean sell it the next day. I mean after you live in it for a year. But sell it. So there's a lot of things changing in 2025. Please stay plugged into Mr. Clark. He brings up-to-date information. Also know that things change often in this industry, and where you might not be qualified today because of one thing or another, that could change tomorrow. So stay plugged in and stay encouraged because it is possible. Very possible. Thousands and thousands and millions of people have done it before you, and they're not any more special than you are. I promise you. I've seen them all.
Yeah. I guess that will wrap it up. I'm like, you got me over here like, amen. But thank you guys again for joining us tonight. Again, if you have any questions after this live is over, you can put it below in the comments. But if you directly want to ask Demetrius a question or kind of get on his list of clients in 2025, because you are looking for the opportunity to own a home and build equity in the future in the state of Georgia and the surrounding states in which he services, definitely reach out to him directly. His email is below. So I don't know if Demetrius had any last words before we jump off here, or
no, just stay encouraged. And okay. I would say good information is sometimes undervalued. And if you're on this call, one of the greatest things that you could do is let somebody else know that Devon does this each and every Sunday. It could change somebody's life or make a difference between somebody being cheated out of thousands of dollars that they never get back.
That's true. And I'm going to give, and what I do now too, because if you want to call Demetrius directly, if it's okay, I'm going to put your direct number on here as well so people can call Demetrius. I know y'all going to be blowing up his line, but he only one person. So you're going to, answer. You got to give him some time, but I'll put his number on here as well. And so you guys can, if you want to reach him, it's 404-396-7445. So if you don't want to email, you feel like it might take too long, and you don't want to, type away with your hands, and you just want to call somebody, because I'm a person that even though texting exists now and emails exist, if I have something that I want to get answered right away, I'd rather call. So if you are like me, so definitely,
definitely good.
I mean, we got one more question before we jump off here, and so if you guys want to reach Demetrius again, it's 404-396-7445. Also, his email is below as well. If you don't want to call, if you're scared, but I suggest you call. It's always better to call. She said, "Sorry, so late. Are there incentives for educators purchasing a home?"
Yes, there are programs, down payment assistance programs, grants for educators, first responders, county folks. You just need to figure out who you are. But I will tell you this, get your credit score up. Like Devon was talking about, there's money out there, but they kind of reserve it for people who have shown that they're credit worthy and have done it before. Most of the programs are going to be somewhere about 650 or 660. That needs to be your average score. That would be a question that you would ask your mortgage person right from the beginning, before you made too much of an application is what type of programs they have. Not if they do, but what type of programs do they have for teachers? Every municipality has that. Something for teachers and something for first responders, because we appreciate you guys. What do you know?
Yeah, I know my cousin, she is a teacher, so. But again, this is Demetrius' phone number, 404-396-7445. Definitely reach out to him, give him a phone call, have a conversation, and get yourself, started on the path of home ownership in the future. Set yourself up for success. You're the only person that can do it. No one else can do it for you, only yourself. So if it's something that you ultimately want, something that you see, a place that you see yourself being in, and you want to create, whether you're the first person in your family to ever do it, and you just want to buy the first house ever to exist in your family, is definitely a place to kind of just start the path and create a lineage that keeps going on, where other people in your family even say, like, this person did it, so I can do it. It's always great when you see somebody do it, you feel like you can accomplish it too. But I just want to thank you again, Demetrius, for coming on here live, spending an hour and some minutes with me, and also for chatting with these wonderful folks that jumped on tonight in the comments. Norma Clark, or my cousin Lang, my dad James Clark, and then also LaSheila Hill, if she's still here. I appreciate you guys jumping on tonight. And like I said, you guys can always reach out to Demetrius via his phone number or his email and have conversation with him. So.
How do we get in touch with you, Devon?
So you can either email me directly at my email address is dclarktherealtor@gmail.com. That's my Gmail account. Or if you want to reach me at my company email account is devon.clark@metrobrokers.com. I don't give out my direct phone number because I don't have a business line. So I don't want everybody calling my phone number. I got to get my own private business line.
Call me. I'll give it to you. I'll give it to you. Call me.
But once you email me, if I feel like you are serious, because I do get a lot of emails, and a lot of it sometimes spammers or people that are trying to commit some type of fraudulent situation in real estate. So I don't want to give out my direct phone number. So when I do get a business personal line, I'll give it out, and then that way you guys will have it. So that way, but anybody can find my phone number, and we can find anybody's number online nowadays. But hey,
pretty much.
I've got strange calls where people saw me on YouTube and then they call my phone number. So, but Lang said, thank you for coming back and sharing your wisdom and knowledge. And hopefully Demetrius will come back next year. Like you said, 2025, every year, there's always something that changes. So hopefully you'll join us again in 2025. And
looking forward to it.
So we appreciate you.
Absolutely.
All right. Well, have a wonderful night. Thank you guys again for joining us, and we'll talk to you soon. All right.
Later. Bye.